Tesla reports earnings after the market closes on Tuesday, and there's a lot to discuss about what is going on with the company. We know what delivery numbers were for the second quarter of 2024, but we don't know what margins look like. The stock is up over 20% just in the past 6 months, so it seems like expectations are going up despite the fact that competition is getting stronger, and it doesn't seem like Tesla has a whole lot of pricing power. So I want to get into exactly the trends that I'm looking for. The biggest thing is going to be margins. What do those margins look like? Because Tesla has been willing to give up margin over the past 18 months to increase deliveries. Not necessarily meet their 50% delivery goal growth. That has gone out the window, but they have been essentially flat over the past year in their deliveries because they've been reducing prices. So is that something that continues? Are they starting to manage inventory a little bit more, produce a little bit less? That is something that they did in the second quarter, so we should see actually better cash flow than we had in the first quarter because they reduced the inventory that's going to be on the balance sheet. But I want to dig into some of these numbers and what I'm going to be looking for when results come out. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's first give an idea of what the trends are for the business overall, because I think these are important. The first chart is a look at quarterly deliveries in red and production in blue. You can see that the blue number has been a little bit higher than the red number. That means that inventory has been building for most of the past 2 years. That really reversed course, reduced inventory by about 23,000 vehicles in the second quarter of 2024. So again, from a cash flow perspective, when you sell a piece of inventory that is on the balance sheet and you sell it for cash, that means you're going to be pulling cash in. So free cash flow should be a little bit better, even if margins went down in the quarter. The downside is you're producing less vehicles, so your fixed costs are spread across fewer vehicles. So that might actually increase your unit costs. So we'll see how these things play out when the numbers come out, but I think that background is important. So from a margin perspective, you can see here that margins have been falling since the March 2022 quarter. That was when things peaked at 29.1% gross margin and 19.2% operating margin. That operating margin is now down to 5.5%. So that's going to be more in line and actually a little bit lower than a lot of the legacy automakers. So we'll see where these numbers are trending. I think the idea with reducing the production in the second quarter is that you're maybe able to goose those margins a little bit. You don't have to give on price quite as much if you're not worried just about volume growth. This is something that manufacturers and automakers have been doing for decades, managing the inventory and their production so that they don't have to give up on price. Tesla was not willing to do that previously, but it seems like that has at least changed a little bit in the past couple of years because, like I said, they're not growing nearly as much as they were. So this balance is going to be really important to watch. I think the worry is that margins are going to continue to be relatively weak, and without any new vehicles in the pipeline, you've got dozens and dozens of new vehicles coming into the market, whether that's in the US or Europe or China. And Tesla doesn't really have any new vehicles. They launched the Cybertruck last year. It doesn't appear that that's doing much as far as units go. And it's not really clear what the economics are of that vehicle as well. Pretty expensive vehicle to make and very expensive price point. So probably not going to be a big impact on the company's financials right now. So these margin numbers are going to be really important if you're analyzing the company from a fundamental perspective, which is really what I'm looking at, is how are the operations of the business doing? Now, expect Tesla to talk a lot about robotics and artificial intelligence and all these other things that would be out in the future because the story has changed with Tesla. 3 years ago, they were talking about how this was going to be an automaker that was going to have massive market share in the auto market because they were going to grow production 50% a year. That has obviously shifted, and now they're talking about artificial intelligence and robotics. As Elon Musk said, this is an AI and robotics company. Ironically, they don't sell any robots, and their artificial intelligence is a level 2 autonomous driving system. So that's just the reality, is that the numbers could potentially be pretty weak, but the story is going to change. So this is always one of the things that's confusing with Tesla, is what are investors going to be paying attention to? How bad can the numbers get before they start to really matter to that long-term story? Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The other number that's going to be important is the energy storage number. And you can see that from this chart here that this has become a pretty sizable business. $1.6 billion in revenue in the last quarter, $400 million in profit. Keep in mind that a lot of that profit is coming from the fact that there are massive subsidies in the US from the Inflation Reduction Act. This is one of the things I've cautioned here on this channel recently is a lot of these subsidies have a massive boon for the business short term, but then eventually they're competed away, just like margins are competed away in the energy business all the time. So this is something where I would expect them to capitalize in the second quarter. Installations were more than double from the first quarter to the second quarter. So we do know that number, 9.4 gigawatt hours installed from the energy storage business. So expect that to be a pretty big number this quarter. But like I said, you're still looking at a business that's only about 1/10 the size of the auto business. So from a margin perspective, from a free cash flow profitability perspective, it is going to be much more important that the auto business is doing well than the energy storage business. On the AI and FSD side, one of the things that I think Tesla needs to disclose and needs to give an idea of from an investor standpoint is how much revenue are they generating for FSD and what's the adoption rate? Because that's one of the things that if the AI and robotics story is going to play out, if this is going to be a company that's going to be able to make a robotaxi, which they said is going to be supposedly unveiled in October now, but that's the kind of product where they're going to need to show that people are actually adopting it. People are actually paying a monthly fee or that one-time fee for FSD. The estimates that are out there are that they're probably in the low double digits in adoption rate for FSD. So that's not a very high level for a product that you would have to put on millions and millions of vehicles to actually build that robotaxi network. So that's a huge question for the company. I want to see what the traction is from the FSD product. Expect that to be another talking point. But again, on these conference calls, they don't give a lot of numbers. They don't give a lot of estimates on when some sort of robotaxi or level 4 or level 5 autonomous system is actually going to be operating. I would love for them to talk about when they're going to actually start rolling this out and tracking data for regulators to try to get regulatory approval, particularly in the US, for a level 4 or a level 5 autonomous system. But that may be asking too much from earnings. But the biggest things that I'm going to be looking for when earnings come out is what does revenue look like? Are they still competing on price? So you can just take that auto revenue number divided by deliveries and you would get an average price per vehicle. That number has been trending lower over the past 2 years. Is that still the case? And are they giving up margin to move product through the system? If they are, that would be a relatively weak sign for Tesla in the fundamental operating business. Now, if you still believe in the story of AI and FSD, that may not matter. But at the end of the day, this is an auto company. Most of what they do is sell cars. So if that business is getting weaker, that is really notable for the investment and for the stock price. So those are the things I'm going to be keeping an eye on, revenue and then margins on the auto business. But what do you think? What are you looking for when results come out on Tuesday? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.